Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. NVIDIA earnings is tonight. CNBC was even talking about having a countdown to the earnings. It is literally, in my mind, kind of the end of earnings season. I mean, I don't know if that's fair to a lot of the other companies out there. But man, you have all the Meg 7s announced earnings probably a month ago, and now you have the biggest one. And you just hope that if you are a company that they mention your company in their earnings report, that has a tendency to actually bump the stock if it is mentioned that you are a client of NVIDIA and have purchased chips. So very interesting. A lot of people are trying to get a handle on the valuation. I still think they're obviously, if you listen to any of the pundits, everybody says, well, in the short term, there's going to be volatility, but in the long term, I think it's going to go up. It's such an amazing forecast. And I don't know why they just keep asking people that say stuff like that about NVIDIA. It's true. You had an opportunity to buy it down around 100, and 100 was the magic number. It couldn't go much below that. So we did get the move down. We do got September and October coming in. And I do think that it adds volatility to the marketplace. And if you don't believe me, watch Monday's show, because I brought in the professor of volatility, Russell Rhodes, the person that has written by far the most books on the volatility index, the VIX. We came up with his favorite trade. Well, I don't know if it was his favorite trade, but he talked about a position that he had on where he is buying in the money puts and buying in the money calls. So a very interesting approach to his VIX trade going into September. And then we also looked at a trade that I have set up and that we've actually been doing in the VIX. When we saw the big spike up to 60 in the VIX index, which we did talk about on the show also, and then it came back down, settled in right around 28 on the VIX index. We got shorted with a modified butterfly is the way that I approached, that I would say that it was. And I actually got fairly big on my position in flipping the script with the VIX down. Well, right now it's at 16, so it's up a little bit today. Got the S&P 500 index down 23 points, or a fraction of a percent. With that mentioned, NVIDIA was up today, and now it's down. It's kind of rallied into the close. September and October, I think. Seasonality is usually just a word that pundits like to use once again when their forecast is incorrect. But over the years, we've seen September and October just underperform the market. And if you look at the VIX index and the seasonality of the VIX, which Russell provided a chart for us on that, you do usually see the highest spikes going all the way back to 2020, going back about, well, I think the chart went back about 10 or 15 years. Gosh, I don't even remember now, but it goes back quite a ways. And you always, the highest points where you see the VIX index based on a year-over-year basis is usually September, and most likely the chart actually showed October was the most volatile time, and a spike all the way back in March too. But Russell had an explanation for that one. So watch the show. It was one of my favorite episodes of Options Guide TV. I will show the trade, and then we're going to get into a fear of missing out trade that we're going to look at in NVIDIA. If you're thinking about dipping the toe in the water, you're a little worried about earnings, but you don't want the stock to get away from you. As a matter of fact, if I do write another edition of the Options Playbook, I actually might coin that phrase for a new trade, much the way we did the fig leaf, in that this is truly a FOMO trade. We're going to sell a put to help pay for a call. So we want to buy the stock if it comes down. And if it got back to the 100 level, I wouldn't mind buying some more. That's where the most recent low was at. And I did actually buy some more in my own personal retirement account. I did actually add to my position. A small ad, but I did want to take advantage of that opportunity. I had some cash sitting on the sidelines, and then just waiting for the election to go away. I think the election is the biggest unknown event, and it just needs to happen. Now, you can make an argument if you want, if you think the markets will go up if the Republicans or the Democrats win. I'm not going to go down that road. I just need the known event to be over with, and once it's over with, I do think that the market will be strong again. And I don't see a ton of headwinds. Everybody still kind of mentions a recession, but I'd rather be bullish. I'd lean. I think the path of least resistance will be to the upside and setting new highs in the SPX and the NDX. And hopefully we drag the Russell along with us and get them somewhere close to new highs going into 2025. Okay. We still have a lot of geopolitical concerns, though. That's probably another big one that's out there. Let's do this. We're looking at the VIX index, and let's pull up the options or Tradier Pro software options playbook. The Tradier Pro software, and here's the VIX index. We see it trading right around 16. And the one thing that we did mention on the show is that the September futures contract, now this is the actual monthly expiration, September 18th. And you know that because it doesn't have a W next to it. We talked about that a lot on Monday's show too. And you see that if you look at the ask of the 16 strike call and the ask of the 16 strike put, they're fairly close. So this is just a quick and dirty way to look at where is the futures market in September. And it's fairly close to where the VIX is right now. And that's surprising to me. So to take advantage of that, because if you go out, well, let me reiterate that. If we go out to the October position and we look at that monthly option contract, you see that that's not the case, right? You see that the 16 strike VIX, the ask is 263. On the put side of things, it's at 80. That is 1016. Yep, make sure. So this VIX or this futures contract, you got to go down and you got to get some equilibrium between the two of them, is right around 18. So 197, let's call it $2 and 214. So it's right around 18 where that marketplace is pricing the underlying that is driving the October futures contracts. So I'm hoping that some event happens in September, drives the market forward. And you can go back and look at the show and look at the setup, but Russell and I talked about so many things. I'm just going to grab the screen grab, which I also tweeted out on x.com. And I'm going to pull it up. Go ahead. We're fine. We don't need to back out here. We're fine. Okay. So this is from Monday's show. And I modified a butterfly in that you go from this expiration in September, the middle of September, the 18th, by the 18 strike, which is where the October futures is at, sell 2 of the 24 strike. And so the difference there is 6 points, and then go up to the 29 strike and buy that option contract. And the difference there is 5 points. Net debit was 36 cents on the account, but this is hard to see. And I probably should have mocked up the graphic actually that I tweeted out in that. Here's your break even. According to the Tradier Pro what if calculator, 1837 based off of, I think, a 36-cent price fill would be your break even. Now, if you notice, if you go up here, there is no break even. On a standard butterfly, once you get up so high, usually you would have a break even price on the high end. But since the width of the long spread is more than the short spread, means we paid up a little bit on the price And we actually are profitable if we get that black swan move like we already received in October, and the market just skyrockets above 29, which is a very high level in the VIX. If you just look at the VIX chart, it's not very often that the VIX hangs around the 29.30 level. And so you do have some profitability. And I think the number was, and you can look over here, right around $60. So if you put it on for, you have 100% gain, right? Well, not quite. 35 to 70 cents. It was like $65 right in this range here. So almost. So ideally you land somewhere within the strikes, within the wings of the butterfly. But that's the position that I came up with. I didn't go into a lot of detail on Monday's show because Russell and I talked too much. We already were pushing the 45-minute mark. So here you have it. This is it. All right. So now let's back out a little bit. And we're going to look at an NVIDIA trade. Okay, so everybody is still arguing about is it overpriced? Can they blow away the numbers again? Is it possible for it to happen? Let's move back out again. And the answer is who knows, right? Whenever you're dealing with something that is considered the future, I mean, look at the volatility that Tesla had. Now, the biggest thing about NVIDIA versus Tesla was actually in a situation where they just needed money. The company was not doing well, but they had a lot of people that were willing to give them money. So that made, there was one point in time where Tesla's bond status was actually considered junk bond status, and it was paying exorbitant interest rates on their debt. It was the most heavily shorted stock, and then the stock took off quarter after quarter. They started saying that they were profitable. I do mean that, in that they had they went through a lot of chief financial officers before they actually ended up getting profitable. And then the stock has done well, and now they're a true car company. Running into competition, there are issues. But my whole point to the story was, how do you evaluate the future? And that's what we're trying to do right now with NVIDIA. They keep blowing away the numbers. How much do they have to blow them away this time around in order for it to be enticing again? And I guess $100 was about the number where everybody jumped back in. If you look at the chart, I guess I can pull that up. Let's do that real quick. And by the way, if you have any questions about the VIX trade, or if you have any questions about anything, please do put them in the chat box. If you are on the Tradier YouTube channel and you're logged in, you can put them in the chat box and I'll try to address them. If you are in the Tradier Hub, you can also ask questions. The last place that we do actually stream this is on my X profile and also on the Tradier X profile. So you can watch it via X, but you can't ask questions in that setup. All right, so here is right where the 100 level is at, and here's the long candle. So on that day, we bumped all the way down to the 90 level, which is going all the way back on the chart. This is obviously where a lot of noise was on the chart, but it did not stay there for a second, and ended up closing above the 100 level. So you had a chance right in this day to buy it right around that level. And I say that that's fairly important because the trade that I want to look at, with it being a Wednesday, and we're going to sell a put in NVIDIA, and you got to want to buy this stock. So my FOMO trade, my fear of missing out trade, is saying I would like to buy the stock at a lower price than where it's currently trading. A one standard deviation move. Now I'm looking at the August 30th expiration, 2 days. We're going until Friday. Market's at 124 right now. One standard deviation move, which is highlighted inside the Tradier Pro graph. It's one of my favorite things about the options chain inside Tradier Pro, is saying that it's right around The delta on this end is 16 to 20. So we're right around 10, 107, 108 is a one standard deviation move to the downside. If we look at the expected move, let's buy the call and buy the put, which means this is what a lot of people will quote on the news channels on a percentage basis. They say that $14 is the expected move. So quite big on a percentage basis. 14 divided by 123 means that we're talking about 11% expected move by Friday in NVIDIA. But now remember, that doesn't have any regard to direction. So it is volatile, to say the least. Implied volatility is right around 188%. Normal volatility is around 69%. So huge spike up in implied volatility. And we're going to try to take advantage of that by selling a put option. Now, if you don't want to buy the stock, what we're going to do is sell a put and then buy a put. But that doesn't give you as much money to buy the call on the upside. So in this instance, I don't want to get it done for a net credit or even on this account, because I do want to try to buy a decent call option on the upside. But I am going to, in my account, I wouldn't mind buying another 100 shares of NVIDIA. So I am going to sell something around where there is a little bit of a bottom in NVIDIA. The expected move is 14 points. So if you look at 123, well, let's say 124 minus 14 would be 110. So we'll go right around the 109 level, and we're going to bring in $2. So we're going to go about the expected move to the downside. So that's a feasible move. The marketplace says that this is a possible move, if you want to call it. The way I like to look at it in the gambling world, if I don't always like to make gambling references, but is the over-under. The over-under of a total points scored in a football game, in a basketball game. This is what the marketplace is saying the over-under is on NVIDIA's potential move after earnings. If marketplace thinks that it's right down to around 109, do you want the over? If you think it's the over, you sell the straddle. If you think it's the over, you buy the straddle. And if you think it's the under, you sell the straddle. So you buy or sell this long straddle at the money. All right. A little long-winded there on that answer. No questions yet. Okay, so 109. So here's my FOMO trade that I would want to do. Fear of missing out. I wouldn't mind buying NVIDIA at a lower price. I'm going to use the shorter term options because if it does come down to that level, I don't want it to bounce back. I actually want to buy 100 shares of it. And it's feasible because it did the 10-for-1 stock split and it's trading at $122 now. So I'm going to sell the 109. And then I'm going to take $2 and I'm going to change this up. I'm going to buy the September contract. I'm going to give myself 9 days on the call side of thing. And this is part of the reason why we're going to have a little bit of a debt situation. Now, if you can do this trade in an IRA account, but you have to be able to buy the stock at 109. That means you have to have $10,900 to be able to buy 100 shares of NVIDIA at that level. So now if I scroll up and I look at what I can buy for a call option in October, we're looking once again right at, just less than a one standard deviation move. The delta over here is right around 20%. And you could do the 139 on the upside and get this done for almost even, right? So I'll put that in right now. This is not the trade that I want to do and make the official paper trade. But look at that. That's net zero. So here's where my concept of FOMO happens. Fear of missing out. All right. To say I want to buy 100 shares in NVIDIA ahead of earnings is a scary situation, right? Do they miss? Everybody's all over the place. Nobody has a real good solid forecast as to what could happen with NVIDIA. We saw it bump all the way down below 100. Now we're back up. All those gains or all those losses have came back. And we're trading at 122. Biggest earnings reports. CNBC wants to have a countdown. Everybody's talking about it. The stock could go anywhere. So instead of buying ahead of earnings, here's one way that we can approach it. We can say, well, I am going to sell a put saying that if it is bad, I'm willing to buy the stock back close to its recent lows, but I'm also worried that it might be really good. And if it's really good, I don't want to miss out on the upside. So I'm going to use those monies to buy a call. And that's my fear of missing out piece of this. I don't want to miss out on the move to the upside, but I'm too nervous to buy the stock outright. The FOMO trade. This is the way that I totally look at this. Now, I don't want just 2 days on my call option. So I'm going to actually pay a little bit of a debit, and I'm going to buy something in the strike. But I don't want to buy an out-of-the-money call outright because there's too much implied volatility. So here's where we go. Oops, I clicked on the wrong one, didn't I? So we need to 109. We're still at $2. Sell that, and we're going to go to September. Give yourself 9 days for this one to play out. 144 would be a one standard deviation move. Look at that. That delta is right around 20%. That's actually not too shabby, but I'm going to go down and pay $1. So I'm going to buy the 139 here, and I hit that ask. All right. So I still don't mind buying NVIDIA at 109. That's the concept. I can set this up in an IRA account if I want. I don't mind doing that, but I don't really worry about $2 in NVIDIA. So if I sold it, I could bring in $2, lower my cost basis by $2, all that. I am way more worried about the fact that I screwed up and I didn't buy NVIDIA ahead of earnings and the stock took off on me and I didn't get that opportunity. So I'm going to take the $2, use it to buy an out-of-the-money call. My out-of-the-money call is going to be the September expiration. That means I got 9 days until that expiration date. And I'm willing to pay a little bit for that. I don't want to pay $3 for it because it's all vol premium. I need to sell something. So I'm going to buy the 139. Pay 94 cents for this entire trade. I'm going to send it to the floor as one trade. And you have to be able to buy the stock. So I need $10,900 on the downside because I'm saying I want to buy 100 shares of NVIDIA at 109. That's where the stock could be put to me and I could buy that stock. And if I'm willing to do that, then I'm going to buy this, use those proceeds to buy an out of the money call option. And it's going to look a little weird because there's two different expirations, but I'm going to send it to the what if chart. There's going to be a little bit of a curve in it. Okay, so here's where the market is at. We're saying that if it comes down to 109, we got some risk because we're willing to buy the stock. But this is where the little curve gets weird. But from 124 on up, right about here, we have a longer term option what did we 139 actually, right? So right about here, we have our long call option becomes in the money, and then we have substantial upside potential on NVIDIA, just in case it does make more than that expected move and blows the market out. And if that is the case, then I can sell my call option. I hedged myself a little bit, take the proceeds, and still buy my 100 shares of NVIDIA after earnings. That's my trade. All right, so we are bumping up against time. Let me move this down. Let's do this. Go back to the software. Let's just move that down a little bit so you get a little bit better picture if you want to take a screen grab or something. But this is our strike right here. Right about here is where our long call option really starts to kick in, is right in that range. All right, so now let's pop out. And that's it for this edition of Options Guide TV. Please, if you'd like to know what I'm doing, please follow me on X. My handle is @BrianOverby. We always stream live Options Guide TV every Monday, Wednesday, and Friday at 11 a.m. Eastern Time. If you want to participate in the conversation, please sign up at the hub. Put a username in, Tradier Hub /Options Guy. We'll take you right to, or Tradier Hub Options Guy. If you Google that, you'll take you right to the show. And we'll see you this Friday after the big event, NVIDIA earnings tonight, and see what happened with NVIDIA. Thanks for stopping in. See you on Friday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.